G'day folks, welcome back to another update for gold and silver. Now gold has retraced somewhat in the last few hours and silver's taken a huge dump. We'll go into the details of that in a minute. Before we go any further, make sure you hit that like and subscribe button to support the channel. Looking at the outlook as of today, April 4th, gold prices surged to a record high of 3,167 per ounce, but dipped 1.4% shortly after. The initial rise was driven by geopolitical tensions and economic uncertainties, prompting investors to seek safe haven assets. The subsequent decline was due to profit taking and a stronger US dollar. Silver, on the other hand, prices declined by over 5% following the US administration's announcement of new tariffs, which exempted bullion. This exemption led to reduced industrial demand expectations for silver, contributing to the price drop. So looking at gold first off, we've got the long-term trends on the monthly. It's still very bullish, as you can see. New highs, there's no CCI drawn for it, but it's well above the moving averages on the monthly chart. On the weekly, we did draw this trend line showing a divergence. So it's lower highs on the CCI versus higher highs on the price. So that's a bearish divergence, and that's still in play. So I'll keep an eye on that. On the daily as well, we've got this lower highs on the CCI from our previous video versus higher highs on the price, and that's also still in play. Now it's dipped in the last few hours of trade, as I said. Now, is it going to come back from there? We're not sure. It could keep, actually, the price could keep rising, but as long as that price rises and that CCI keeps falling, we're going to call it a bearish divergence. But we'd like to see it fall like back into the moving average range like it did back here to start executing that bearish move. So that's the daily. Now if we go to the 1 hour chart, we look at the micro level, see what it's doing there. So again, at the moment, taking predominantly short trades on the smaller time frames. So you can see there, we've had a double top on the CCI back here on the 1 hour chart versus higher highs on the price. That actually dipped, and let's just measure that, see how far that dropped there. If that hit our 23% target, so we'll take it back to that, let's take it back to that low there. You can see there it hit initially our minimum target range. That should have been drawn a bit lower. About there. So it's already hit that minimum range there. It bounced out of there, went a bit higher, but you'll notice the CCI kept dropping, and that still also fell further from there as well. Currently, if you were to draw that Fibonacci to that level, you can see there it reached the 61% level before bouncing off that. Currently it's gravitated back towards those moving averages and still falling from there. The CCI seems to be neutral at the moment, so just cautiously going short only based on the daily if you're trading on that one. Now if we look at the back test, we'll go to the long trades, and now long trades would have been executed from on the daily where the CCI broke above the moving averages and the price was already above the moving averages, so you would have taken long trades from there and you would have closed out your long trades once that CCI broke down into that moving average band. So that starting point of the back test begins here on those points there on the 1 hour chart. Let me just get rid of this Fibonacci. So again, you can see there the stop loss approach. You would have been in a negative at the moment. So if the baseline is 100,000, you dropped initially to about 99,400. So you would have lost about $600, and currently you're down about $400 on that. On the average down approach, you averaged down a few times there, once there and another time there as well, and you would have closed out the last trade at that point there. And that would have generated $315 using the average down approach. So at the moment, don't go long. So don't trade any more long positions until you see the daily break higher as well. The price is already higher on the daily. We just want to wait for that daily to break higher as well. Alternatively, if this starts trending more bearish, wait for the daily to break into the bearish mode as well. So for silver on the monthly, that's still bullish on the CCI and also bullish on the price chart. Although notice we're having a bit of a pullback in the current month. On the weekly, likewise, we've been in a decline for some time now on the CCI, even though we've made almost new highs. But this week so far, it's a very bearish momentum at the moment on the weekly bar. But you'll see the CCI is also broken down into that moving average range on the weekly. And that was a result of this bearish divergence which we forecast early last year. And if to draw a Fibonacci on this one, go from that high down to that low, initially hit our target range in that 23-38% level, went just below that 38%, bounced out of there, and currently it's retracing back towards that 23% range. On the daily, it hit this, didn't quite get as high as that previous hard resistance up there at 34.87, but it just bounced down below that 34.24, and it broke strongly below the moving averages, giving us a very bearish outlook, with the CCI also. Now, again, that was a result of this bearish divergence, lower highs on the CCI versus higher highs on the price, and that's still in a bearish momentum. If we go to the 1 hour chart, first we'll look at the 1 hour chart on its own without the back test, again taking short trades only. You can see there is a slight bullish divergence there. So lower lows on the price, but higher lows on the CCI. That's a bullish divergence. So we may see a pullback from there. And as a minimum, retrace, we can expect it to get that 23-38% range. Let's mark it in there. That's a minimum range it'll get to. It could go higher, but of course this could actually fail as well. If this price keeps dropping and the CCI keeps dropping below that, we're going to continue that or maybe invalidate that divergence. But at the moment, that divergence is in play, and that's our initial target. I wouldn't be trading this long because you don't want to go against the trend. You don't want to be grabbing a falling knife. So avoid going long. We're just going to see if it does retrace. And if it does retrace and starts breaking down again, that's where you may want to start taking short trades again. Now, if we look at the back test, again, I've marked the back test here from that on the daily when that candle there broke into that moving average range. And that's indicated by these two stop loss approach and the average down approach. Now, in this case, because the price is very strongly in a downtrend, the stop loss approach entered a few trades and it's closed out with 6,465 profit with a baseline of 100,000. And the average down approach averaged down a few times there, and that generated 15,615 so far. Like I said, at the moment the CCI is bullish, so avoid going long or short until we see this break further to the downside, and then you can continue further short trades. So here are the back testing or trading parameters. So if you're trading on the 1 hour time frame, you invest per trade 1 contract, the first contract entered, and you average down limit of 15 contracts. So basically the contract entries, the first one is 1 contract, next lot is 3, you've got a total of 3 contracts now running, add another 4, you've got a contract, 7 contracts running, add another 8, and then you've got a final of 15 contracts maxed. And every time you average down, you make sure it drops by at least 0.005% for a 1 hour trade or contract parameter. If you're trading on the daily, the average down is 5% decline. Now, trading shares is very similar. Invest per trade $1,000 per trade. So you invest first $1,000, next lot is $3,000, next is $7,000, and finally you got the max of $15,000. And again, average down by 5% if you're trading on the daily time frame, and take profit of 3%. If you want to follow the traditional stop loss strategy for trading CFDs on the 1 hour time frame, you invest 1 contract per trade, take profit of 0.003% or 3% for a daily trade if you're trading on the daily time frame, and a stop loss is when the CCI 150 turns into the moving averages. Likewise, if you're trading shares, if you're trading on the daily time frame, invest per trade $1,000, take profit is 3%, and again, stop loss when the CCI 150 turns into the moving averages. Obviously, you can invest more than $1,000 in any of these trades, but you've got to be very careful of the your money management and your account balance. And I've limited it to 3% take profit on the daily and 0.003, the equivalent for the 1 hour time frame, because I found if you make it too high, in other words, if you aim for a 5 or a 10% gain, often you're a lot longer in the trade than you really expected, and it just gives you a lot more turnover when you're the smaller take profit return.
To support the channel, hit that like and subscribe button, and for added benefits and for a cost of a coffee each month, consider subscribing to the Patreon page where we look at weekly scans of bullish shares across various regions. Thanks for watching, and see you in next week's video.